Hello everyone, welcome back to Boss Economic World. I'm your host, and as always, we are here to peel back the onion of the global economy, wipe away the tears, and find out who is actually cooking the dinner and who is just getting cooked. Today is December 1st, 2025. We have officially entered the final stretch of a year that historians might one day describe as the Great Hesitation. If you're feeling confused by the markets, don't worry, the people running them are even more confused. We are standing at a fascinating crossroads. The data is messy, the politics are loud, and the central bankers of the world are doing their best impression of a statue standing very still and hoping the pigeons don't land on them. Today, we are going to restore the full picture of this global economic puzzle, from the frozen interest rates of Frankfurt to the tariff-battered ports of Brazil. Let's dive in. Let's start in Europe, where the European Central Bank is preparing for its December 18th decision. If you are betting on a dramatic move, keep your money in your pocket. The word on the street, and by street, I mean the median of 29 Bloomberg forecasts, is that the ECB is going to sit on its hands. Why? Because the headline number is playing nice. Consumer prices in the Eurozone likely rose 2.1% in November. That is painfully close to the magical 2% target that central bankers dream about. But here is the truth behind the event: averages lie. While the headline number looks calm, the underlying measure, the core inflation that strips out the roller coaster of energy prices, is stuck at 2.4%. That is sticky. That is stubborn. It's like gum on the shoe of the economy. Vice President Luis de Guindos told Bloomberg TV on November 26 that the risk of undershooting is limited. In plain English? He's not worried about prices falling too low, he's worried they won't stop rising. Meanwhile, President Christine Lagarde is doing her usual diplomatic dance, telling lawmakers that policy is in a good position. But let's look at the map, because the Eurozone is not a monolith. It's a dysfunctional family. Germany and Spain, inflation is coming in hotter than a jalapeno. France and Italy, the numbers are weaker than a wet paper towel. This divergence is the nightmare scenario for a central bank. How do you set one interest rate for a continent where half the countries are overheating and the other half are freezing? You don't. You enter a holding pattern. You wait for the quarterly forecast stretching to 2028, hoping the future looks clearer than the present. The economists are just as split as the countries. Bloomberg Economics says inflation will slow, signaling rate cuts. But BNP Paribas? They are throwing a grenade into the consensus. Paul Hollingsworth, their head of developed markets, just released a note saying, as we move into 2026, we expect the ECB to see stronger growth and inflation. We continue to see the next move as a hike. Imagine that. While the market prices in cuts, the smart money at BNP is betting on a hike. If they are right, 2026 is going to be a bloodbath for anyone holding short-term bonds. Now, let's fly across the Atlantic to the United States. If you think the data in Europe is mixed, the data in the US is missing in action. Thanks to the recent government shutdown, a lovely annual tradition in Washington, the Bureau of Economic Analysis is only just now releasing the September income and spending report. We are looking at the economy through a rearview mirror that is 3 months old and cracked. Here is what we expect: a third straight 0.2% increase in the core index. Year over year, we are hovering just below 3%. The truth, this is the stagflation light zone. Inflation is stable, yes, but it is stable above the Fed's goal. It's sticky. But the real drama isn't the data, it's the personnel. We are in the quiet period before the Fed meets on December 9th to 10th. But the White House isn't staying quiet. Kevin Hassett, the director of the National Economic Council, went on Face the Nation this Sunday. He wasn't just talking about the weather. He was touting a market rally based on rumors that Donald Trump is about to pick a new Fed chair before the year is out. And who is the front runner? Hassett's boss, the chief economic advisor. This is critical context. The markets are currently pricing in a rate cut for December. Investors see it as a sure thing. But look at the labor market. The unemployment rate has ticked up to a 4-year high. Companies are announcing layoffs daily. Yet, the payroll numbers showed a larger than expected rise. How does that happen? Concentration. The job gains are narrow, clustered in a few specific industries, while the broader private sector is shedding weight. The ADP figures and ISM surveys coming this week are going to be the lie detectors. If manufacturing and services show contraction while the official payroll numbers look good, we know the economy is running on fumes. Briefly, let's look at our neighbors to the north. Canada is the classic example of when the elephant rolls over, the grass gets crushed. The US trade war, reignited by America First policies, is battering key Canadian industries. The Bank of Canada is holding rates at 2.25%. They are predicting a soft labor market. In Boss Economic World terms, soft labor market means you aren't getting a raise, and your cousin might lose his job. Heading east, the narrative shifts from inflation to stagnation. China is the story everyone is watching but nobody wants to talk about. Data published Sunday shows Chinese factory activity improved slightly but, and this is the kicker, remained in contraction for November. This extends the streak of declines to a record. The engine of global manufacturing is sputtering. When China slows down, commodity prices crash and supply chains wobble. But the most interesting story in Asia this week isn't a number, it's a person. As of today, December 1st, Anna Bremen begins her term as the governor of the Reserve Bank of New Zealand. Why does this matter? 1. She is the first female governor. 2. She is Swedish. 3. She is the first foreigner to lead the bank since 1934. New Zealand is often the canary in the coal mine for global monetary policy. They were the first to hike, and the first to cut. Bringing in an outsider like Bremen suggests that the old playbook isn't working, and they are looking for fresh, perhaps radical, ideas to handle this new era of fragmentation. Meanwhile, in Japan, Governor Kazuo Ueda is keeping markets on edge regarding a December rate hike. And in India, the central bank is expected to cut the repo rate on Friday. India is trying to position itself as the new growth engine while China stalls, making borrowing cheaper to fuel domestic consumption. Finally, we must look at the global south, because this is where the pain of 2025 is being felt most acutely. The consistent narrative here is, the party is over. Brazil, for the last 3 decades, Brazil has not seen a growth streak like the one they just had at 16 straight quarters of expansion. But new data due this week is expected to show that the streak died in the third quarter. Why? 2 reasons. 1. Uncompromising domestic monetary policy. 2. Trump's tariffs. This is the reality of 2025. The trade war isn't just a headline on CNBC, it's a wrecking ball for emerging economies. Look at South Africa. Their growth likely slowed to a crawl in Q3. Why? Because the US slapped a 30% tariff on specific exports. That single policy decision in Washington wiped out manufacturing momentum in Johannesburg. Mexico is in the same boat. Investment is dropping like a stone. The nearshoring boom that everyone hyped up in 2024 is hitting the wall of protectionism. And Turkey? Inflation is easing to 31.6%. In any other world, 31% inflation is a catastrophe. In Turkey, it's progress. Governor Fatih Karahan expects improvement, which might trigger a rate cut. But let's be honest, cutting rates with inflation at 30% is like trying to put out a forest fire with a water pistol. So, what is the full picture? What is the truth behind these events? If you look at the data points in isolation, they look boring. Eurozone inflation is flat. The US is waiting on data. Asia is mixed. But when you connect the dots, a terrifying picture emerges. We are entering an era of synchronized uncertainty. 1. The policy trap, central banks in Europe and the US are paralyzed. They can't hike because growth is fragile. They can't cut aggressively because inflation is sticky. They are stuck in the middle, hoping time solves the problem. 2. The trade war tax, the resurgence of protectionism is transferring wealth from emerging markets to the US Treasury, but at the cost of global growth. The supply chains are breaking again, not because of a virus, but because of politics. 3. The disconnect, there is a massive gap between financial stability and economic reality. The next 2 weeks are pivotal. We have the ECB decision, the Fed meeting, and the final inflation prints of the year. If BNP Paribas is right and the ECB has to pivot back to hiking in 2026, or if the US stagflation forces the Fed to keep rates high despite the political pressure from the White House, the soft landing narrative is going to crash and burn. My advice? Watch the boring data. Watch the German factory orders this Friday. Watch the South Korean trade numbers. These are the pulse of the real economy. The stock market is just a voting machine, but these numbers are the weighing machine. Right now, the scale is tipping, and it's not in our favor. This has been Boss Economic World. We analyze the truth, we laugh at the absurdity, and we help you protect your wallet. Stay sharp, stay skeptical, and I'll see you in the next video.